Hi, it's Paul Sankey. Starting out the week this week, I think the dominant story for the oils is clearly going to be ExxonMobil's earnings guidance that came out at an 8K at the end of last week after the market. Huge increases in oil, gas, and refining earnings across the board. The back of the beer mat suggests that Exxon, after doing $8 billion of earnings clean in Q1, I know that was about $2 EPS, will just about double that number to about $16 billion of earnings, driven by the aforementioned three key elements, towards I'm getting about somewhere around 350 to 380 earnings for Exxon this quarter. Very, very big numbers. The one area of concern was chemicals, where earnings quarter to quarter were flat for Exxon, and that does indicate that we're into economic slowdown territory, which has been the concern alongside peaking inflation. So the market reaction is going to be interesting, because now all the other companies will be ringing around to guide the market for Q2 earnings, and that will involve a lot of upgrades, obviously, across the board, particularly in refining, but also in all the oil and gas companies, essentially, which now have relatively muted hedging exposure. The political reaction, of course, was predictably, I couldn't believe it, because with Exxon having reported what they reported, Joe Biden tweeted out once again blame for high oil prices on gas stations, which, as we all now know, engendered a reaction from Jeff Bezos, whose company Amazon is the biggest consumer of diesel in the US. Jeff doesn't do a bad job of consuming oil either himself, what with his yachts and private planes, but that's beside the point. The fact of the matter is that as a huge consumer of diesel at a corporate level, Jeff was unamused, let's say, by the Biden administration's continuing willingness to blame gas station owners on high oil and gas prices, which of course isn't the case. If you're worried about why the gas price is high at the pump, it's related to tight refining capacity and a couple of things that the Biden administration could change, namely the renewable fuel standard requirement, which has ethanol into gasoline. More efficient ethanol forces gasoline prices higher at the pump. And of course, the Jones Act also constrains the movement of oil products from the Gulf Coast to the East Coast, which would essentially alleviate East Coast prices, but in fact causes the companies to tend to export marginal additional products out of the country because it costs too much to move them within the US. So they're still getting it wrong at the Biden administration level, and we'll be very interested to see how the market reacts to Exxon's earnings this week. For the rest, just looking at Russia and the other major reason for high oil and gas prices, which is going to be obviously the Russian issue. The more we look at Germany, the more we're convinced that they can't survive without Russian gas. The German chemical industry employs 4 times the number of people that work for Exxon, about 360,000 people in the German chemical industry. And we just can't make the balances work. And knowing that, the Russians are now squeezing gas supply into Europe very severely, knowing, as I mentioned, as we all know, it's midsummer. That's going to cause a huge problem going into winter, and that'll be a theme note for us. Hopefully this week we'll look at that balance and just how it doesn't work out in Europe. Behind me, Wall Street. I hope you have a great week. Bye.